Thank you everyone for joining. This is the next edition of the RSN Investor Insight Series. Maximize your 2025 tax strategy, straightforward advice to pay less tax. And we are joined today by Ryan Perlman. So I like to frame Ryan as a little bit of a wonder kid. He's really progressed his career faster than many, and he has ascended to the point of founding his own firm and had a lot of success over the years. And we're really happy to have him here joining us, giving us a lot of advice about real estate taxation matters. Ryan, why don't you say hi?
Thank you so much for the intro, Ben, and I'm really excited to be here, everybody. As Ben mentioned, I've been involved in tax for over 15 years and really excited to discuss some topics in the real estate world today.
Fantastic. Now, guys, we're going to start with a disclaimer. Often we don't read these things, but taxation is an important topic where you do need to consult with your CPA. So this presentation is for educational purposes only, not intended as tax, legal, or investment advice. Despite the fact that Ryan is a CPA, you do have to consult your own CPA. The information we're presenting, we believe it to be accurate, but individual circumstances vary. There could be errors, omissions, or something could change in tax law after we post this. And the most important thing, this presentation is short. Many examples are oversimplified to convey the general topic in an understandable manner. Entire books are written on many of these topics. Now, again, always consult your CPA before making tax or investment or any other major financial decisions. That said, we are excited to get into this. In the next 30 minutes, we're going to talk about RSN's tax-centric investment philosophy. We're going to break down depreciation and passive losses, talk about who benefits and how to benefit from passive losses. We'll talk about 1031s, and then we'll also talk about investing through tax-deferred accounts. Then we will do real unscripted live Q&A. This is not a recording. If you are on the chat right now, hit the Q&A button, give us questions, ask follow-ups. It's 100% real. You might hear a dog bark or a baby cry or something in the background because we are here to answer your questions live and real. And with that, I'll move quickly and jump into RSN's tax-centric investment philosophy. So for those who aren't familiar with RSN, we do have a lot of great multifamily deals. And unlike other firms, well, a lot of firms do it, but we try to take it to the max. We really want to maximize the year one investor losses for optimal tax impact for you guys. So we utilize depreciation, bonus depreciation. We'll do cost segregation, sometimes one, usually two. And we'll control our expenses, including buying a bunch of materials before the end of the tax year, front-loading contracts. And we're going to get into a lot of these terms and explain them to you as part of this presentation. But the net, as you'll see on the right-hand side there, a previous K1 that we issued that had 80% of what investors invested coming back as tax-deductible passive losses in year one. And why is tax-efficient investing important? Take a look here at an example of $100,000 invested with a 10% return over 30 years. And the orange line is someone who's paying tax on those distributions every quarter. And the blue line is someone who is offsetting their taxes by making other smart investments or other smart tax decisions. And we're talking about a $1.18 million delta between the two returns. Now, again, this is an overly simplified example, but the point we're making here is that being tax efficient really can boost your overall returns. So with that, enough of me talking. We're going to pass it over to the expert, and Ryan is going to talk about depreciation and explain that for anyone who may not know fully what it is.
Thanks, Ben. So at its core, depreciation is really a tax deduction, right? It's reducing the profit and loss that is coming from the building. So what it does is when you buy a building for a certain dollar threshold. And what the IRS allows is for you to take a deduction over a certain amount of time. So in this example, since we are talking about multifamily, apartment buildings depreciate over 27 and a half years. So let's give a ultra simplified example, as Ben mentioned. If you buy a building and the building portion is $275,000, we divide that by 27 and a half, and we get $10,000 of depreciation a year. And that 10,000 is going to reduce whatever profit and loss is coming from the books in a given year.
Perfect. And jump into passive losses and their relation to depreciation.
Yeah, so there's a lot of confusion between, oh, everyone, I can take depreciation. Depreciation is a component of passive losses. So passive losses is really what is the net income coming from the property less the depreciation, and that is in theory the loss that can be passed out to you as an investor. And so now that we understand a little bit about what a passive loss is, or in some cases could be passive income, if we take that same example of the $275,000 component, we're getting a $10,000 depreciation deduction. If the property produces, in our example, $5,000 of cash flow, which in this example, we're assuming cash flow is net profit, you can reduce the 5,000 by the 10, and that results in a $5,000 passive loss that would be allocated to you on your K1 at the end of a given year.
Great. And now bonus depreciation has been a huge topic in the news, part of the one big beautiful bill. So Ryan, give us a breakdown on bonus depreciation, please.
Yeah, so this is the hot topic of the year. Bonus depreciation is back. And how does that help? I mean, it's extremely powerful, Ben. So as you guys saw in the last example, you buy a property, you have to depreciate it over 27 and a half years. Not a big deal, right? But bonus depreciation, what it does, it allows you to pretty much expense 100% of certain property. And how do you do that? So first off, a group like RSN would do a cost segregation study. A cost segregation study is a study where you hire a firm, they allocate the purchase price to the building as well as shorter life property. What is shorter life property? It's appliances, fixtures, and landscaping. Because when you go buy that multifamily deal, you're not just buying the land and the property, you're buying the fixtures, the equipment, the dishwashers, etc., that are in there. And so what the cost segregation study does is it breaks out the components of that building. And so to sort of show you guys this example, if we take the same numbers that we were working with before, the 275, and we take an allocation for simplicity, 30% of the building is shorter life property, that would result in $82,500 of straight up depreciation year one, plus the portion of the building of 7,000. What ends up happening is you end up with an $89,500 deduction in year one. And so to sum it all up, the property produces 10,000, subtract out the depreciation, you end up with a $79,500 loss. Much better, Ben, than in the prior example of $5,000, and we're taking the same numbers.
No, it's fantastic. We have live deals now. We'll talk about them briefly later that we're going to produce a certain amount of passive losses. And just by virtue of this bill passing, those losses are going to be much, much more significant for 2025. So look, let's talk about passive losses tax treatment. So if you invest in a passive syndication investment like an RSN deal or other similar deals, you're going to receive passive losses. And one of the big myths or misconceptions out there that is often promoted by different operators is that that can offset ordinary income. That's not actually the case. Now, the passive losses are still incredibly powerful, but you need to know how to use them, which is what we're going to talk about in this presentation. The beauty is they're unlimited. They don't phase out. So you can basically use an unlimited amount of them in any year, and they do carry forward to the next year if you don't use them. So you'll always get to benefit from them one way or another. Now, directly owning real estate, people will somewhat colloquially and maybe slightly inaccurately refer to this as depreciation. But what they're really getting is passive losses where you're allowed to deduct up to 25,000 per year from your ordinary income. However, that phases out if you're earning 100 to 150 grand in adjusted gross income. So for anyone earning more than 150,000, directly owning real estate is not going to produce depreciation or passive losses that can offset ordinary income in any way different to investing in a passive syndication. Now, the exception to this rule is if you are an IRS designated real estate professional, that materially participates in their portfolio and or does an aggregation election, which can reclassify all of these passive losses as non-passive for federal tax purposes, meaning they can offset ordinary income subject to different annual limits and phase outs, and they do carry forward. And Ryan, help me out very briefly on the excess business losses basis and at-risk limitations.
Yeah, so the excess business loss is something that came up in the past but became permanent within the One Big Beautiful Bill. And what that basically says is you can't really use this real estate professional losses against income that is investment income, such as your interest, dividends, as well as your W-2 earnings. You can use it up to a certain extent, and that value is going to change. This year in 2025, it's about 600,000, it's a little over 600,000 if you're married and a little over 300,000 if you're single. But like you said, that's an ultra simplified version. And then regarding the basis and at risk is you have to have basis in order to take losses. So meaning you have to have enough debt basis or you have to have put money in order to take the loss.
Awesome. Thank you. Deep topics. We could go a lot deeper, but we're going to be brief. Now, let's talk about what the IRS considers passive income, because there are things that people might think are passive that the IRS doesn't consider. We'll talk about that on the next slide, or at least Ryan will. But things that are passive: direct rental real estate. If you own the property yourself, even if it's professionally managed, that rental income is generally passive income. So passive losses will offset that. Now, syndicated real estate and private placement investments like RSNs or similar, you invest through a partnership or a fund as a limited partner, and almost all LP and fund investments produce passive income, when they're successful, of course, that offsets those passive losses. And passive ownership in an operating business is the other big way. Now, this could be perhaps you own a business and you're getting a little bit older and you decide that your children or your other family member is going to now run that business, or it may be that your staff run that business now, or it may be that you have an uncle who you lend 50,000 to, or you invest 50,000 in his business and you own a stake in that business. In those kinds of scenarios, the income that the business produces is considered passive income, again, offset by those passive losses. But many things that you may think are passive income are not necessarily so. So Ryan, jump into this for us.
That is true. So anything that you consider is your active business or, employment, right? So what does that mean? That's your W-2. I work for X, Y, and Z. That's how I earn my dollars, right? And so that is not considered passive because that's an activity that you're actively doing. What else is not? Portfolio income. That is not necessarily active, but it's considered separate. So what is that? That's your dividends, your interests, mutual funds, things that you think of when you get a dividend from Apple or Disney, or your mutual funds, right? And then C, capital gains. Capital gains, there's a caveat, which I'll get to in a second, but traditional capital gains, hey, I sell my Apple stock and I make all this, that is not passive. That is just considered capital gain income. The one caveat, which can be very powerful, is capital gains from selling a passive activity can be utilized and offset by passive losses. What does that mean? If you're a passive investor, and let's just say you're an investor in one of the RSN deals and you are a passive investor, when a deal sells and there's going to be a gain from that deal, if you invest in other, let's say, RSN deals or other real estate deals that you are passive in, and those deals create losses, you can use those losses to potentially offset the capital gain. Once again, this is a generalization. Every individual taxpayer has a different situation, but it can be something very powerful, and it's something that you should discuss with your tax advisor anytime you have a big event as such.
That's great. So let's talk about who benefits from passive losses. So right out of the gate, every single RSN investor or anyone investing in similar deals with other operators are going to receive passive losses proportional to their ownership. And again, those losses offset passive income from distributions that this deal or other deals produce. And those suspended losses that you maybe don't use do carry forward indefinitely. And upon full disposition of your investment, those losses do unlock and can offset all income types that year. So everyone does benefit from passive losses, but there's cases where you can accelerate the tax benefits of those passive losses to really reduce that tax drag and reduce your overall returns. So someone who's already generating passive income in their portfolio is going to benefit more so from these passive losses. So this could be someone on the call who's invested as an LP in a number of real estate deals or partnerships or credit funds, business owners who either just own a business producing passive income, or perhaps they're even leasing property to an unrelated entity or unrelated business entity, professionals who invest in a lot of partnerships or funds and receive a lot of K1 passive income, and long-term landlords or 1031 investors with stabilized assets. Now, the third one here, and the one we just wrote a big article about, and we can go into a lot of detail on, and people are very interested in, is becoming an IRS designated real estate professional, where you have to spend 750 hours and more than 50% of your time in real estate trades in a given year. And you have to materially participate and aggregate it's called a grouping election. And then those losses can offset active income. And this is the holy grail of tax efficiency. It's a powerful strategy if documented properly, but it does require a lot of knowledge about the decisions you're making and understanding how to do it, and working with a CPA who is very familiar with doing this kind of thing. As an aside, even my CPA that I used on the regular was not very familiar with this when I became a real estate professional, and I had to get outside help to make sure I was doing everything the right way. Now, the last group I'll talk about here is strategically structured investors. So these are people who either are currently or are willing to intentionally shape their portfolio to produce passive income streams to absorb passive losses. So this means making investments in passive income generators, as they're called, and essentially trying to make those investments that provide passive losses near the end of the tax year, because they will apply to the full tax year. It's not going to be prorated. So it's an important point to make there. And you can reinvest any passive income into tax efficient investments. And that will really compound your growth, because you're reducing your taxable income, you're making good investments, and it comes together to really drive your returns and what you're getting out of your portfolio. A lot to take in there. Excited for some Q&A later on that. For now, we're going to jump into 1031 roll-ins and deal level roll forwards. So Ryan's going to get into this in more detail, but essentially a 1031 exchange allows you to sell a property and then invest all of those proceeds without paying taxes, deferring taxes, into the next deal, which can greatly accelerate and compound your returns. But Ryan, give us a bit more of an overview and talk about some of these rules for us, please.
Absolutely. Thanks, Ben. And sort of as Ben noted, we're going to go high level here, but I could teach an entire class on 1031 exchanges. It's a really exciting topic and a really great way to save on taxes as you're continuing to build your wealth. As Ben mentioned, what is a 1031 exchange? It's where you're selling a piece of property for a value, and then you're going to go reinvest all of those proceeds to go buy another property. What is like kind? So the property needs to be, let's say, real estate. You can go from multifamily to a retail deal or industrial to another, but it has to be real property. So in this sense, it's got to be real estate. You can't go sell your car and go buy and upgrade your car, right? That's not going to work. And then there's specific rules. So the timeline is you need to identify a replacement property within 45 days and then close on that replacement within 180. So once you sell your property, you have to already start thinking, what property am I going to go buy? You have 45 days to basically write down some addresses on which you want to go after. And then you got to close within 180 days of the time that you sold your original property. And in order to really fully utilize the benefit, you're going to want to buy something that is either equal or greater value. So you sell a property for $3 million, not what did you buy it for, but what did you sell it for? $3 million. You want to go buy something that's $3 million. And you also want to replace the debt. And there's a lot more specifics, but that's high level what's happening. And then most importantly, the money can never touch your hands. So you need to work with a qualified intermediary. That really is like an escrow agent. There are a ton of them that this is all they do is hold funds, and they're the ones that are going to be basically transferring from the sale to your new purchase. And now I will let Ben take away some of the other key benefits of a 1031 exchange.
Thanks, Ryan. Great overview. So, guys, I'm not going to read all of the bullet points on the slide here. You can read some of them yourself, but look to the graph on the right. You've got two investors. One of them is not doing a 1031 every time they sell their property. That's in the orange line. And then you've got someone in the blue line who is doing a 1031 every time they sell their property. And the net result is similar to that tax drag example I showed at the start. You're really reducing that tax drag. And the guy who does 1031s now has three properties. The guy who doesn't has one property. So it's a huge benefit to be able to do 1031s, to not pay tax every time you sell a property and continue to just roll those proceeds forward. It can really accelerate your wealth accumulation in a major way. And there's a lot of other benefits. So again, we're trying to be brief here. It's a complex topic. Feel free to hit us up in the Q&A. And RSN can help you with this. So if you own an eligible property, must be a rental or an investment property, can't be your primary residence. I think you have to leave your primary residence for 2 years approximately before it can be considered a rental and do a 1031 on it. Anyway, I'm getting into details there. But sync with us early and we can help you through this process. You need to engage a qualified intermediary like we talked about, and that's very easy. There's a lot of them online. There's competitive services and prices and a lot of good people providing this service, and you can close and reinvest those funds in an IRS compliant manner where you have true fractional title interest in the property. And again, we can white glove that process for you, working with your CPA, qualified intermediary, and attorney. We've been doing this for over 10 years, I think is fair to say, and we were one of the first groups that was doing it. So we're very experienced. We know what we're doing. We'll look after your 1031. Now, we've talked about a 1031 roll-in. The next 1031 we want to talk about is a deal level roll forward, which is where we, as RSN, sell a deal with investors in there, and we allow the investors that choose to roll their funds forward in a 1031 that we coordinate into the next deal, making it a little bit easier on the paperwork and logistics side for those investors willing to move forward with us. And we have the expert here to tell us more about these deal level roll forwards.
Yeah. So in general, when you invest in a deal, and if RSN were to say, hey, you know what, we found the next great deal and we cashed out, we had a really good hold on our prior one, they're going to present the new offering and say, hey, look, if you want, rather than pay taxes on the gain that you have, you can roll in your equity plus your share of the gain into the new deal, right? And that's the whole idea is now if you were, typically speaking, you put $100,000 into the deal, the next deal, you may now have $150,000 in equity in the next deal just because you decided to roll that forward as well as not pay any tax on that increase. So that's sort of the idea in terms of like the economics of what's going on. But if you decide to say, hey, you know what, I want to cash out and I have other objectives, that's okay too. And what happens is that you'll be able to cash out, you'll get your share that you would have gotten if RSN did not do a 1031 exchange at all. And then you will get allocated your share of the gain that would have been allocated to you had the deal just completely sold and not done a 1031 exchange.
Fantastic. Now, let's talk about investing through tax deferred accounts. So some people out there are familiar with self-directed IRAs and whatnot, others maybe not, but conceptually, if you have a 401k or an existing IRA, you can roll those funds without any penalty into a self-directed IRA or one of these other account types that fit your personal circumstances. Again, without penalty, without fees, or with nominal fees, I should say. But then you can use those funds to invest in an RSN deal or a privately owned real estate deal or any other deal that you see fit. And inside that account, the taxes will be deferred. So the income that property produces, there will be no taxes on that required at the time you receive it. If you sell the property and receive capital gains, again, no taxes due at that time. just like a 401k, when you start to cash out that money at the end, you will pay tax on it. But this can be an excellent way to invest in real estate, in RSN kind of deals, and basically take control of your retirement fund and invest in the things that you want to invest in that are aligned with your goals. Now, there is a disclaimer here that Ryan is going to speak to.
Yeah, so the one thing to note though for everyone is most retirement accounts are subject to something called UBIT, unrelated business income tax, which is a result of, on the disclaimer, UDFI, which is unrelated debt financed income. And what is that is the IRS just doesn't really love leverage, and most real estate deals have leverage. And so there may be a tax component. It's really an individualized item, but it's something to note and bring up to your CPA if you're considering investing through a retirement account in real estate.
Fantastic. And as I alluded to before, setting up a tax deferred account is easier than you think. You work with a self-directed IRA or 401 custodian. There's a lot of groups out there. We're not necessarily recommending them, but Equity Trust, Advanta IRA, they are good people and they're big names. There's a lot of groups out there that you can work with. Usually only takes a couple of days to get the account set up. And again, you can roll over your funds from an existing 401k, and this can be from a company that you've left. In many cases, it can be a company that you're still employed by as well. So there's no taxes or penalties with this if it's done properly. And, I set one of these up recently, and I think it was around about $300 and, really low fees. So it's not something that's going to cost a lot of money and introduce a lot of complexity into your life. And then ultimately you select an investment, whether it's RSN or another eligible private investment with any other group or direct owned real estate. And like I said before, it'll grow tax deferred subject to those disclaimers. So let's summarize here. And then we're going to jump into some Q&A. So please do pop questions in the Q&A and ask follow-ups if we don't quite answer your question correctly. But look, all RSN investments are structured for maximum tax efficiency. We really want to maximize those passive losses for our investors. And you should ask the same question of any deal that you're going to invest in to understand the tax profile of anything you're putting your money into. Now, passive losses can offset an unlimited amount of passive income, but they don't offset ordinary income. Again, if you qualify as an IRS designated real estate professional, there are ways to have those passive losses be considered non-passive and offset your ordinary income. Passive losses benefit virtually every investor and reduce taxable income. But by being smart about it or already being in a position where you have a lot of passive income, you can dramatically reduce your taxable income in 2025 and beyond. And again, if you invest at midnight, 11:59 on December 31st into an eligible deal, those losses will apply to the full 2025 tax year. Similar to people who buy a car or a business vehicle right near the end of the tax year. Investors with unused passive losses can strategically make investments that produce passive income to dramatically compound overall returns, bringing in that income, having it offset, and reducing that tax drag that we talked about. And the last bit of the summary here, then I'll take a breath, is that investors with an existing property can consider selling and executing a 1031 exchange into one of our deals or directly owned real estate transaction or any other deal that permits these transactions. Highly recommended if you are looking to sell a property in the foreseeable future to consider a 1031. And again, at the RSN level, we always offer a deal level 1031 roll forward when we sell. So you can roll forward your funds in that manner with us if you choose to. You can also take your funds and do what you want with them. Now, in addition to deferring taxes and allowing the full proceeds to be reinvested when you do a 1031, you still will also receive additional passive losses, further compounding the growth. There's a lot of details that go into that. It won't be as much as if you were making a fresh investment, but you are still receiving additional tax benefits when you do a 1031. Now, investors with funds in their 401k or an existing IRA can roll these funds into a self-directed IRA or other compatible tax-deferred account, and the income and appreciation will compound tax-deferred until retirement, just like a traditional 401k. Now, that all said, guys, we've given you a lot of good info. I'm going to take 30 seconds to pitch two deals that we have. These are great deals in their own right. We can talk about that in a lot of detail. Alessia Gardens is looking to produce about 70 to 80% of your investment will be returned as passive losses in year one. And some at 401 is going to be probably closer to 65, 70 based on the cost seg reports and other data we have, subject to disclaimers. But again, I'll make the point, these are great investments in their own right, roughly projecting to double your money over a 5-year period. And you're getting these great tax benefits that can help reduce tax drag and overall portfolio efficiency. So if you are interested, you can head on to rsnpropertygroup.com/commit to register your intention to invest, or you can reach out to Willie Morales with the details on the screen here. And again, you got to get a sales pitch now from Ryan. It's well deserved, Ryan. You've been great on this webinar so far. There's more Q&A to come, but take a minute to talk about GCP, please.
Yeah, thanks, Ben. So yeah, as co-founder of GCP, I have over 15 years of experience in the tax and accounting space. GCP is located in Century City, which is within Los Angeles, and we represent ultra high net worth families, family offices, real estate syndicators such as RSN, real estate families, and folks in the entertainment and athletic industry. We focus not only just on tax compliance, but also on consulting. And we work really closely with estate planning attorneys to come up with estate planning strategies. So we're not only trying to mitigate income tax, but also estate tax.
Great. Thanks, Ryan. And look, if you're not an ultra high net worth individual, still consider reaching out to Ryan. They do help, everyday real estate investors that might be on this call. So highly recommend reaching out to them if you're considering upgrading your CPA to someone who really does know the ins and outs of real estate, like very few other CPAs do, and can really accelerate your returns, your growth, and overall success in life, I dare say. Now, with that, let's jump into some Q&A. So please pop questions in the Q&A box at the bottom of the screen there, and we will look to take some questions. We have a lot of questions here, guys, and I'll try to group similar questions. Okay. Look, I'm going to take a softball question here to start this off. So Michael, thanks for the question. What is your minimum investment for a 1031 exchange? So typically we say 500K. Now, that said, if we're in a deal and we're allowed to have, let's say, 3 or 5 1031 exchange investors, and there's one slot left, and you might come along and say, look, I've only got 150, 350, whatever it is, we will absolutely consider that. And there's a good chance that we'll be able to fit you in. So, do come to us, with any amount, but officially it is 500K. And if hypothetically, you were the first person, we wouldn't be able to let you in for, 150. But again, if we have multiple people and we're already incurring a lot of the costs required with bringing in 1031s, we can allow ourselves to minimum. Now, okay. David Fuston, thank you for the question and nice to have you joining us. Does a syndication allow for bonus depreciation, or do you have to be a direct owner to qualify for bonus depreciation? Ryan, please take that one away.
Yeah, so the syndication qualifies for bonus depreciation. So bonus depreciation, just to reiterate, is really just a way of depreciating the overall property. It doesn't matter if you directly own it or a syndicator owns it. That's just the rule of when you purchase a property, you depreciate it. With that being said, how you utilize the bonus depreciation depends on whether or not you are a materially participating real estate professional or if you're a passive investor.
Great. Thank you. Thank you. We have a couple of questions on recapture taxes. So I'm going to kind of group them together. Question there from Donald that you should be able to see, and an anonymous attendee here. Nice to hear from you, Donald. Please take it away, Ryan.
Yeah, so recapture is also one of those things that is really commonly asked, right? And what is recapture? So when you do a cost segregation study and as we just talked about, bonus depreciation, what the IRS says is, well, hey, you just took 100% bonus depreciation on this property. When you sell the asset and we have a gain, what the IRS says is part of that gain is really allocated to that shorter life property. And therefore, you have to pick that up as what the IRS considers as ordinary income. So, if you had shorter life property of, let's just say, $100,000, um, and upon exit, and you fully depreciated it, right? So now your basis is zero. So any dollar, the IRS is trying to say any dollar that you get from the sale that came from that asset needs to be recaptured and picked up as ordinary income, which would be at ordinary income tax rates. With that being said, there's a lot of planning that gets involved in a sale and trying to figure out what is the true allocation. So when you own a piece of real estate, if you own that real estate for more than 5 years, there may not be as much recapture because the new buyer is not necessarily putting a big dollar value on that equipment that you fully depreciated when you bought the building 5 years ago. And so that's generally how depreciation recapture works. Um, Also, to add, if you're a passive investor, and let's just say you never used any of your passive losses because you didn't have other passive income, you can utilize those passive losses to offset the recapture and the gain that would come about from an exit. And if you do a 1031 exchange, which is interesting, Ben, is that you can actually sort roll the recapture into the next deal. So that's one of the other benefits of doing a 1031 exchange is you don't pick up the recapture on a 1031 exchange, assuming you meet all the requirements.
Right. Solid, comprehensive answer there. Let's move them away. And bear with me, guys. I'm going through a very big list of questions. Feel free to throw more in. We've got a good just over 20 minutes to answer some. Now, we've got a series of questions here from Jeff. I'm going to group them together here, Ryan, and if you could maybe answer those ones, please.
Yeah, so in terms of the self-directed IRA, I don't want to get too far into it because it is an extremely specialized niche. With that being said, I mean, if there's a rollover, if you're rolling something from, let's say, your 401k to a self-directed IRA, or you had a regular IRA and you want to roll it into a self-directed, there should be no reason why that would be taxable, assuming that you never touch the money and it's just going from one financial institution to the other. So I hope that helps answer that question. Um, and in terms of how is UBIT and UDFI, I mean, really, if you end up going into investments with your uh, retirement account, you will actually have to file a separate return and it goes on this other tax form. And that sort of does get grouped into understanding what is your overall um, unrelated business income tax. And we, as the tax preparer, will provide that information for your individual CPA to make those calculations. But Jeff, I'm happy to talk offline to go into more detail, because it really is a more uh, intense conversation. You have to really go one by one.
Right. Look, we've got some questions here. I'm going to pick up some softballs. Will you please email these slides to process them at our own pace? We can't email you the deck, but what we're going to do is send out a recording after this, and you'll be able to pause that, rewind, go back and forth. And of course, you can reach out to us at RSN or Ryan if you have additional questions. Um, now,
Why don't we take John's
sure,
question?
do it.
So, one of the questions, so if you make over a certain W-2 threshold, and let's just say you have W-2s, 1099s, and dividends, can you use bonus depreciation? You can't use the bonus depreciation that will then equate to passive losses will not, if you're a passive investor, um, would not necessarily help offset those types of income because those are all active or portfolio income. But it would be either A, you can hold it for passive income in the future, or if you have other passive income, you can use that to offset.
Yeah, thanks, Ryan. And John, yeah, hopefully that's clear. And like I pointed out, there's a lot of you know, misinformation that the passive losses can offset ordinary income, and I hope you haven't heard that and been disappointed. But again, there's a lot of ways that you can, utilize those passive losses and make smart investments and structure yourself to really benefit from them outside of being able to offset your W-2 income. Now, with that, Ryan, I just forgot we haven't turned our videos back on. So let's turn our videos back on and I'll stop this share so people can
There we
see
go.
us like we were supposed to do. And then
Exactly.
answer some other questions here. Now, there's a good one about reps. So why don't you just take a swing at this? I wrote a big article about this. I know you liked it, but I'm going to let you take this one away and I'll add any color as needed.
Yeah, sure. Just in general, talk about real estate professional status.
Well, there's a question here. I'm a reps, but I invest as an LP through a trust and holding company. Am I able to claim those reps tax benefits still?
So if you qualify as a real estate professional and you make something called an aggregation election, typically speaking, you can aggregate all of your real estate income as one because it's considered one activity. And therefore, if I am an investor that has my own real estate business and I want to put some money into an RSN deal where I'll be the LP, if I group that and I already qualify as real estate professional status, you would be able to use those losses against your real estate income, assuming everything else is okay. Regarding the trusts are a little different, and so that, yes, in theory, you could qualify. It's usually based on the trustee. Um, and I'm happy to answer the trust question offline because that gets a lot more specific into details that is not as generic as traditional real estate professional status. But in general, if I'm a real estate professional and I hold investments in LPs, yes, I can take those LP losses against my other real estate income.
That's great. Now, there's another question about real estate professional status. And the question is for someone close to qualifying, what kind of documentation or proof is actually needed? And I'll take a swing at that to start, and then you can fact check me.
Yeah.
But you really want to. So again, I'm a real estate professional, and my case is very clear. I run a real estate firm. I'm involved. We will still, in my family, document real estate related activities in a log. And when we were a little bit maybe more on the borderline, that log was in a lot more detail, listing like, hey, look, that's what we did this week. These are the activities we worked on. This is how many hours. In the event that you get audited, the IRS is going to look at that, and that's the first thing they're going to see. Okay, look, you're very clearly a real estate professional. Maybe you're on the line. Let's start looking at that documentation in great detail. And if you make it easy for them, you're going to have a lot easier case with that audit than if you don't have the information or the information is messy. These guys are trying to recover as much money as they can as quickly as they can. So making it easy on them means they're going to generally give you a little bit of a easier run if you're on the fence there, so to speak. Anyway, I've maybe answered part of the
Yeah.
question that wasn't intended by this, but Ryan, please add more color.
Yeah. So regarding real estate professional status, it is a highly scrutinized area, right? Because what they're trying to do within the IRS is say, all right, Ben clearly qualifies. This is what he does for a living, right? What they don't want is the mom and pop who, has two W-2 jobs and they own one piece of real estate, and then they want to start just investing in all these syndicate LP deals and then say, yeah, let me just group that and qualify, right? Because what they're trying to do is, are you running a real estate business? And you really are, unlike, are legal, you're sort of guilty until you prove to them that you are a real estate professional, right? They're going to want you to prove it. It's not you qualify and they have to disprove it. So you really need to take really good records and really work with someone who understands that, right? You have to spend more than half of your time in real estate, more than 750 hours. And there's a lot of, hoops and ladders you have to go through to make sure you qualify. If you do, as Ben mentioned, you sort of hit the holy grail in tax. because then you can continue to invest in those deals and continue to reap the benefits against some other ordinary.
No, it's fantastic. So, for me personally, I can be at the end of the year, I'll do tax planning, and I know I have whatever it might be, $100,000 tax bill coming due. I can just make an investment and immediately offset that. So I don't pay taxes, and then I have an investment that, produces cash flow, grows in value. So again, a very powerful tool if you can legitimately qualify. The other thing that we haven't mentioned yet is your spouse could qualify as well. So you could maintain your W-2 job in whatever field it is, and your spouse could qualify and provide all the documentation requirements, and you would collectively be a real estate professional status on your tax return.
Yeah.
Now,
Uh,
another
why don't
question,
we,
another question
what
about
about
this.
this one? About passive losses on the K1, but the property is cash flow positive.
I tell you what, let's
Uh,
grab that one next. There's one more question about real estate from right at the bottom. Kim Can. If I plan to get my RE license in the future, can I utilize the passive loss carryover as ordinary income when I get my license? Or does the passive loss carryover have to match the year I become a real estate professional?
Yeah, so it does have to match. So if you have passive losses that are sort of what ends up happening is they pretty much get trapped in there, and then the day and it actually becomes very useful the day you become a real estate professional. You sort of have to take an overall high level view of the income taxpayers, whole income status, because it may be beneficial to wait a year before claiming a real estate professional status. It just depends on when there's an exit. Because if not, you sort of have these losses trapped until that specific deal closes. But they aren't lost forever. You're still able to use it. At the end of the day, the one thing I think that really brings this point home is real estate professional status uh, gets you losses right away. Passive losses that are trapped, they're not truly trapped. It's just a timing difference, right? So someone with real estate professional status may get the deduction today, but the person who's passive still may get benefit of that just 2 years down the road. So it's never lost. It's just a timing.
Thanks. Thanks. Look, that's a lot of questions on real estate professional status. Which one was the one you wanted to grab? The passive losses on the K1?
Yeah.
Take it away.
All right. So, question is, I understand passive losses show up on my K1, but if the property is cash flow positive, how is it possible that it still shows a loss? And as we sort of reiterated today, it's depreciation, right? Depreciation is the one thing that is not affecting cash flow. It's on the purchase, and every year you're going to get to take a piece of that purchase as an expense. And so that's why in a lot of real estate deals, you'll see that you get a loss showing up on your K1, but you'll still be able to actually receive distributions. So that's really the powerful tool where you're starting to receive, let's just call it like a dividend on your money that you invested in, but not actually paying tax until years down the road.
Funny anecdote. My old CPA saw one of the K1s for a deal, and they were like, "Oh, I'm really sorry about that deal. It must not be going well." And I'm like, I laughed. Like, no, no, that's just passive losses, my friend. Property is doing excellent. Okay, next question. If I don't have any passive income, do these passive losses still help me at all?
Yeah, so what ends up happening is it just will help you down the road. So it could be this is your first investment that you create these passive losses, and as you keep building them up over time, eventually certain deals are going to sell and you're going to be able to utilize these passive losses. But ultimately, it will be used. It's just a matter of timing.
Yeah, that's right. And typically, again, I keep referencing RSN deals because I know them the most, but our deals are going to produce sort of maybe a 5, 6, 7% yield on your investment every year, averaged out. And those distributions are passive income, which will be offset by the passive losses. So effectively, all of that money is staying in your pocket, and you can then reinvest that and really reduce that tax drag again. So the other thing I'll say is, it might seem like it's tricky to do, to be tax efficient and to make smart tax decisions when you're talking about potentially your first investment. But by the time you've sort of made three, four, five, six, and you've got a portfolio with a lot going on, all of these options really do start to open up in a bigger way. And a smart CPA can advise you on this and really help you with this. And that's where you're really going to compound that growth. Now, we've got a great question down here from Rodney Estel, who's asking about his own situation. I'll let you take this one, Ryan.
So only if you have passive income and RMDs, can I benefit from a K1? And so if you have passive income, depending on assuming that the passive income is truly passive according to the IRS, then yes, the losses that would be produced by the deals that we were discussing, one of these real estate deals, you would be considered passive, and therefore the losses would be able to reduce your passive income. It wouldn't necessarily be able to hit your IRA, your RMDs, but it would be able to reduce your other passive income. And to sort of follow up that, Ben, with does recapture come into play when you sell in 3 to 5 years? Once again, it depends. We'll strategically work with a group like RSN in terms of trying to mitigate the amount of recapture and working with the purchase price allocation or the sales price allocation, I should say, and trying to mitigate the amount of recapture that investors would see. But in theory, yes, you would be subject to some ordinary income recapture.
Yeah, and Rodney, you could be someone from that category that I put up on the screen in the top right, investors who have a lot of passive income. And let's just say you have $80,000 coming in as passive income. If you make a $100,000 investment in Alessia Gardens, you would get $80,000 in passive losses, which would completely offset that income in that highly simplified scenario. But the point I'm making is, yeah, you should definitely look into this in more detail. You could be a really great fit to benefit from these tax benefits. And Rodney says the RMDs is considered passive income. I'm not familiar with RMDs myself, Ryan.
So RMDs are not, because it's IRA, really required minimum distributions from your IRA.
Got it. So it's passive income, but you're saying the IRS strictly in the sense of passive losses and passive income doesn't consider it passive income.
It's really it's like portfolio. I mean, it's money that's coming from your retirement.
Got it. So sorry, Rodney, that might be disappointing news for you, but potentially some facts that'll help you as you do structure your portfolio there. Good answer, a good question from Jeff here. You see that one, Ryan? I'll let you take it. It's a big one.
Let's see. Does the strategy for the holding period, if applicable, or if take a large part in the property selection process, does it vary, or can I expect the property will be sold a certain number of years down the road? Is it widely unpredictable how long the property will be held?
Probably more
I'll work in tandem with you on it.
Yeah.
I guess take it away in terms of like timing. I would imagine none of these, I can say, no one goes into these types of investments assuming you're going to flip it in a year with what I can see. But Ben, why don't you sort of take that part of the process?
Sure. So different operators will hold properties or project to hold properties for a different period of time. Some groups will do a 3-year hold, a 5-year hold, a 7-year hold, a 10-year hold. It's usually not more than that because investors, want to get their money back. At RSN, we consistently do a 5-year hold without any exception that I can think of right now over the last 10 years. Now, that said, we've had properties that we have got a great offer on 2.5 years into ownership, and it makes sense to sell, and we have. There's properties that we purchased that, if you know a lot about the commercial real estate market, it didn't do well in 2022. No one was selling properties in 2022, 2023, unless they were forced to. So we do have assets that were probably due for a sale that we've held on to for a little bit longer. and investors are happy about that because you don't want to make a sale into a bad market. Anyway, I'm diverging from the point here. It is a little bit unpredictable, but yes, typically a 5-year hold with a year or two grace in either direction. That said, Ryan, do you want to add to that or expand?
I think in general, there's not a exact percentage of what we'll be able to say this is the exact amount of recapture that we're going to take. I think in general, once the property is purchased, we can work, we just try to strategically work with RSN on terms of when a sale comes up. We'll try and strategically work with RSN and the lawyers to figure out the best approach to minimize the amount of recapture on the sale.
Fantastic. And then Rodney says he might have missed an early part of that response. So Rodney, we can't give it back to you in full, but I'll sum up by saying if you've got passive income, these passive losses can directly offset that passive income. So you're one of the individuals who could really benefit from an investment like this. So please take a look at it, watch that recording, hit us up with questions. Question from Lords. I'll pass that one to you, Ryan. When you buy a house, is it better to depreciate it only once in the first year, or is it better to spread it out over the years of the loan?
So I'm assuming when we're buying the house, we're buying it as a rental property, and it really depends on the tax situation of the individual. In general, typically speaking, you want to, accelerate depreciation, right? You always want to accelerate losses. But there are times where it may make sense to hold off on accelerating the depreciation to the following year. Because maybe you have a sales event where you'd end up in a different tax bracket, et cetera. And so it comes down to there's a lot of tax planning involved in terms of answering the specifics, but I think it's a individual by individual question.
That's a CPA answer. The answer I'd give you is it's better to depreciate as much as you can, as fast as you can, with those disclaimers applied, and benefit from those tax deductions as quickly as you possibly can. Reduce tax drag. Anyway, we won't agree on everything, Ryan. I'm just joking. Now, let's take a look at a couple more. Oh, actually, we're almost at 5 o'clock Eastern time. We're going to have to wrap it up. Thank you, everyone, for the excellent questions. There's been a huge attendee list, a lot of great questions. Ryan, any parting thoughts?
No, I appreciate you having me on here, and please feel free to reach out if we can help answer any of your tax questions.
Great. Thank you, everyone. All the best.
Thank you.